Hey everyone, this is Saim, your Crypto CPA from the Lone Star State here at Akif CPA. I know this tax season, many of you have been sending us questions regarding DeFi, lending, and borrowing. So in this video, we're gonna teach you how DeFi really works and what's happening to your money and the big tax mistakes that can cost you huge. Here's the thing. DeFi is not like your regular bank. There is no banker, there is no credit check. Instead, you're dealing with what? Smart contracts. These computer programs, they automatically match people who want to lend with people that want to borrow. You put your crypto into a liquidity pool. The protocol gives you either a receipt token of some type or gives you a place in that pool. So that receipt token is stating what your share is in that pool. And now here's the important part. If the value of your collateral drops too much, to protect the pool, liquidity pool can liquidate you automatically without any questions, without any warnings, without giving you any kind of indication. So that is a forced taxable event that can occur in a liquidity pool at any given time. The next one is, how does interest really work in DeFi? So basically, whenever you lend your crypto, you get a nice monthly interest payment, just like you would in your bank. The balance changes every single time you redeem those rewards. So depending on which protocol you use, either the receipt token balance grows or the token itself becomes more valuable than the original cost of you putting money into that pool. That 10% APY that you see today, it could be 5% tomorrow, it could be 15% tomorrow. The IRS treats crypto as property. So whenever you earn yield or interest, that's income. You owe taxes on it. Second, whenever you swap or exchange, that's a disposal. So that can give you a capital gain or loss. Now, where do people get trapped? The biggest problem isn't the tax rules themselves. It's tracking everything, doing the crypto accounting. Once you start using multiple wallets, multiple chains, and multiple protocols, you end up with hundreds of thousands of transactions, but every single one needs to be accounted for. Doesn't matter how small it is. So what you need to know, what's income, what's an exchange, what's a disposal, what is your cost basis, and what is that balance change that occurs after you make that exchange. And this is why tracking tools are so important and required. And the more active you are in DeFi, the bigger those gaps can get. Now, here's one of the most powerful moves in DeFi. Let's just say that you have Bitcoin and that has gone up in value. If you sell it, you end up paying capital gains, right? Tax right away. But if you borrow against it, you can certainly get cash without triggering any capital gains, and you can defer those capital gains. And in most cases, you might even be able to deduct interest expenses, those interest costs that you pay, the interest fees. If you're structured right, you can deduct those costs too. So right now in crypto, we don't have that wash sale rule that stocks have. What does that mean? That means you can sell a losing position, claim the losses, and buy it right back. So this particular strategy needs to be intentional. This is not just something you're doing haphazardly. This is something that you're doing methodically, with a plan. The IRS is actually now getting really good at tracking crypto, and the tools, analytical tools, are proving to be good. So it's in your best interest to be organized and use the tax rule to your advantage, so you can literally eliminate, if not reduce, that tax bill down to a minuscule proportion. When you do this organization by wallet, by activity, you can easily reconcile your transactions regularly and not just once a year. You can look at this again and again, every month, every quarter, and this will give you an insight as to how your strategy is doing. So keep enough detail that you can reclassify things if the rules get more specific. We do this day in, day out, and we make sure we provide a full and complete data set to the IRS. My job here is to make sure that the on-chain activity turns into a clean, defensible numbers, and where possible, turn this into a strategy that you can legally reduce what you owe without relying on guesswork, loopholes, or any other small little gimmick in the law that could disappear tomorrow. And this was it. This is the end of our video. Make sure you like, subscribe to our channel, drop us a comment in the section below, and we'll make sure to look at that comment and get to that and cover that section this year.